Every month, another letter arrives. Your premium is increasing again. You haven't filed a claim, you haven't changed cars. So why are insurance companies raising rates all across the United States in 2025? Stay with me, because behind those numbers is a story of inflation, disasters, and a system that's quietly resetting how it prices risk. In early 2025, auto and home insurance premiums jumped by an average of 17% nationwide, the largest increase in over a decade. Major insurers are blaming a perfect storm: record vehicle repair costs, higher medical bills, and unprecedented storm losses. But there's more. Behind the official press releases lies a hidden cycle of economic pressure and profit correction that most consumers never see. Let's start with the obvious: inflation. From 2021 to 2025, the cost of auto parts rose nearly 40%. A simple headlight replacement that once cost $800 now runs well over $1,500, thanks to all the new sensors and camera systems. Paint materials, labor rates, even windshields, everything costs more. So when one fender bender happens, insurers pay thousands extra compared to 5 years ago. And guess who covers that gap? You, the policy holder. Then comes Mother Nature. From California wildfires to Florida hurricanes, the frequency and severity of catastrophes have doubled since 2018. In 2024 alone, insurers paid out a record-breaking $90 billion in weather-related claims. To offset those massive payouts, companies adjust their catastrophe models, raising base rates even for states that didn't face a disaster. That's why drivers in Kansas might see hurricane-level premiums. They're helping to fund losses nationwide. You've probably heard it. Some insurers are leaving your state. In 2025, companies like Allstate and Farmers scaled back operations in California, Florida, and Louisiana. It's not because they're going bankrupt, but because they're rebalancing their risk portfolios. When large players exit a market, smaller companies step in and often charge higher premiums. Fewer competitors mean less price pressure, and that leads to more rate hikes. It's basic economics, but with a very real impact on your wallet. Another hidden cost is fraud and lawsuits. Every year, insurers lose billions to staged accidents and false injury claims. Add in attorney fees and medical billing inflation, and you have a system that quietly inflates every single driver's premium. For companies, raising rates is the simplest way to protect profits against these unpredictable liabilities. But here's a part most people never hear about. Insurance companies don't just hold your money, they invest it. When interest rates were low from 2021 to 2023, their investment income fell sharply. To make up for those lost returns, many insurers adjusted their pricing models in 2024 and 2025, passing the costs to customers. Simply put, lower bond profits equal higher policy premiums. So what can you actually do? First, compare quotes from at least 3 different companies. Every state still has pricing gaps of 20 to 30%. Second, check for safe driver or multi-policy discounts. They can cut your bill by hundreds. Third, maintain a good credit score. In most states, it directly affects your rate. And finally, stay informed, because knowing why rates are rising is the first step to reducing what you pay. Insurance companies aren't just raising rates, they're rewriting the rules of risk for a changing world. From climate disasters to economic shifts, every dollar in your premium tells a story about how the system is evolving. Now you know the hidden truth and how to stay one step ahead. If you found this helpful, like the video, subscribe, and share it with someone wondering why their bill just went up again. Thanks for watching.